we'll see you around the timeline. Feels good to be back.
I think The Rollup is one of the most premier media brands in crypto, and Andy and Robbie are great experts at everything they talk about, and it's my favorite podcast.
Adding it to my library as we speak.
Potentially multi-chain deployments.
We are at DevConnect Day 1 here. I'm with Jesse from Base. JP Morgan, BlackRock, DTCC, Fidelity. The entire thing was just institutions. It's next level. This industry is going to the next level. And guys, I don't know what else to say. I'm bullish.
He said it, he finally said it.
I'm so bullish.
Andy's bullish, I'm bullish, we're bullish. Is headed to the top. If we're not already at the top, we're going to the top.
We're going.
Rollup is my favorite.
From all walks of life, all over the world, all over this industry, come together for the roll-up.
Zoom out. The institutions aren't coming. They're simply here. It's the golden age of crypto, guys. Get right. Let's go.
Welcome to the nest. See you on the show.
What's going on, guys? Welcome back to Tokenization Tower. You're watching the roll-up, broadcasting live from the financial capital of the world. Today's August 18th. We have a great show ahead of you today. Let's give it up for our team behind the scenes. Atan, Alex, Megan, Nero, Leo, Marcelo, Nara, Aliona, Kate, Robbie, the whole gang, and more. Let's give it up for them this morning, putting in a ton of work. Good to see you, Freedom Guy in the chat. Good to see you, NFT Art World. YouTube is not hiding the best live show. We are live here today. Great show. We got two guests, one coming here in the tower, another coming in after online, institutional folks and kind of in the trenches folks. And then we're going to talk about the way to structure your winning digital asset portfolio 2026, what that means. Put out this tweet yesterday, kind of covering what I think the kind of fundamental leaders are for this new cycle. It's a beautiful day in New York City. I mean, you got Jersey down there, absolutely lovely. You've got Brooklyn down there. You can see it all. You can almost see my apartment down here. Shout out to all the lovely sponsors: Plume, Denari, Chris Berniski, Benjamin Graham, the New York Knicks, new chain link hat, and Zama in the corner, which you can't see. And as always, our friends at Plume, building on-chain asset management infrastructure with their Vault credit products. Visit plume.org to learn more, guys. Market's ripping. Bitcoin looks fantastic. Bitcoin bulls are about to wake the hell up. We break above 65. We break above 67. Things are going to get fun. Stocks are down. A little bit worrying. You don't want to see stocks down when our finally fabled fallen Bitcoin soldier is ready to make us move. But we'll talk about it. We'll see what we see out there. As always, guys, if you're watching on YouTube here, give us a like. Give us a subscribe. On X, same thing. Means a lot. I'm going to go in and just make sure all my Twitter folks know that we're live. And let's get this show on the road. Today, what do we have? We have Markets Weather live from New York. We got the Mobius CEO joining us in the tower, and the Benefit Street team. This is a subsidiary of Franklin Templeton. So they'll be talking to us about the, rise of the institutional investor, which we already know. Druckenmiller aped purse, literally smashed our bags. So did big boy Kenny G. Griffin was buying our purr bags. And PTJ, Paul Tudor Jones, adding to his IBIT positions, to his Bitcoin positions. We're in a good spot. Coca, good to see you. Have a good stream. Have a great day, Coca. They're hiding you from me anyway. I had to turn my phone off and restart to get the show to pop up. Damn, we're getting nuked on YouTube. We're getting obliterated, huh? Too much sauce. All right, guys, let's get into it. Let's get into our markets, weather, and more news section. And I want to get into what a winning portfolio looks like based on what I've been seeing out there. Before we do, let's get into our daily show here with Denari, building infrastructure for tokenized U.S. equities and bringing real-world stocks on chain. Visit Denari.com to explore on-chain access to public markets with their new product, tokenized S&P 500, available to all U.S. investors today. Guys, it's 88 degrees in New York City, partly cloudy, pretty warm. I think it's closer to 85, smooth 75 degrees. Yep, I had to search. No notification to be found, buddy. Damn. What's going on with that? Can somebody on the socials team figure out why our notifications are not popping up? YouTube, not ideal. Warm day. Let's get into the markets, guys. Before we do, let me tell you about Frax, our premier stablecoin partner, open, stable, and borderless. Visit frax.com to learn more about their new FraxNet launch product. It's going quite well. Digital dollars, one-to-one, swap, mint, redeem on frax.com. We have a special link for you as well in the link description. All right, guys, what's happening in the market? Bitcoin's green. Broke up to almost 65 earlier today, which was great to see. And Ethereum is also green. Solana's green. Chainlink and Near slightly red. Broadly, market looks good. This is a nice kind of testing of the higher levels of the range. We were in the lower levels of the range. Now we're back in the higher levels of the range. Also, Robbie's not here today. He's dealing with I think he's got mold in his house. He'll tell you about that tomorrow, I think. So just me rocking today. We'll get into the markets more, but I want to just kind of go into more of the kind of market stuff as we get into building the portfolio. So that'll kind of segue us nicely. But for now, stocks are lower. The SPX and the QQQ are down, about 0.5% and 1.5%. Oil's up a little bit. Tech is kind of taking a hit today. It's probably over. The intraday pullback isn't over. And we'll see. I think if you're looking at tech correlation, obviously you just want to see those names kind of hold up, giving us a little bit more of a runway for crypto. Oil is keeping the inflation risk alive. This is the biggest risk. Oil in inflation for the Fed rates, and then also this Japanese yen carry trade. And then, of course, these long-term yields are still applying some pressure on the bond market, which is affecting investors' outlooks for kind of allocating more risk capital. But there's a ton of money sloshing around. AI names are still looking good. I think we are poised for a nice crypto rally. We'll see. We'll see what happens. All right, guys, let's get into the news section and more. As always, our digital assets market is powered by our friends at Zama. Visit Zama.org to learn more about their confidential FHE-based computing technology. You can deposit USDC on Morpho in a confidential fashion. The first confidential vault ever on Morpho with Zama's CUSDC product. Check that out. All right, guys, let's get into the news and more. Token versus equity, dynamics, news, markets, etc. Before we do, let me tell you about Near, your home for discovering and using apps on chain. I'm trading Near Perps constantly now. It is my go-to trading venue for perps. One account, no borders, your financial life on chain. We will have a Near Perps roll-up front end very, very soon for you guys. It'll be really, really good. I think you guys will be excited to see it. And it'll be kind of like a roll-up branded place for us to make our theses together and then execute them live. So, all right, guys. Centrifuge, a name we don't really talk about. Quantum Rose, it worked for me. I didn't find you. You guys found me on the timeline. What's going on, man? Welcome to the show. We're live every day from the Empire State Building, one of the most beautiful views in all of finance, covering crypto, AI, tech, finance, markets, and more. Give us some love. Appreciate you being here. So, Centrifuge has published a governance proposal exploring a transition from token to equity. The CFG token was designed for a different centrifuge. Yes. Just like many of the previous tokens were designed for a different era of, well, you could say extraction. The business today is institutional infrastructure, and the token structure has become a constraint on the partners we can work with and the capital we can raise, i.e., every partner is asking these guys, well, why do you guys have this token? And what risks and what liabilities does this token bring? This protocol explores giving eligible CFG holders the option to convert tokens into equity. Eligible. Basically, I think this is something that I expect to happen. I think there's going to be more of this. This kind of comes back to the last couple conversations we've been having on the show. Yesterday with Rob, and then I think Friday, which was about token versus equity. It was about buybacks, whether or not they work. It was about durability of revenue. You know, a lot of these companies are now being faced by the pressures of the market who, you know, we see this right now with Venice. Venice is having an amazing day. However, the community just won't stop yelling at their CEO, Erik Voorhees, about the token equity split. And we see this now in the discourse and in the rhetoric. And so I expect more teams to follow Centrifuge here. I think that they're on the right track. I don't think it really is going to affect anything in the token market. I also think it's going to be very hard for them to rescind the token and issue equity. And how eligible holders versus non-eligible holders will be determined. What happens to the eligible holders who don't select to do this? What happens to the ineligible holders? So good to see you, Shine. Good morning. Hope you're doing well. Hope you're riding this move. Bitcoin looks great. Lighter looks great. Pump holding up. Near, Zcash, Venice. A lot of our favorite coins doing well, Shine. So hope you're doing well. So yeah, man, I think this is a consistent trend that's going to continue to happen. And I wouldn't expect anything less from teams feeling the pressure of the market. What is the CFG token doing? CFG. So I guess it rallied a little bit on this news, but it had this massive pump earlier in the year and it's pretty much fully retraced it, down a good 70% from May. So yeah, I mean, one last ditch effort here, I suppose. So hope they do well. Hope that tokenized equity can better align what they're building with institutional capital. It's actually funny that some of the pre-token companies now have an advantage than those who already launched token. All right, let's keep it rolling. So there's this new rhetoric going around. P&L is the new way to show legitimacy. And it's like basically saying, soft influence doesn't matter. If you have P&L, then, your profit is the thing that determines your value in the market. And, if you're not showing this profit publicly, well, you're not, capable of commanding attention. And it's pretty similar. Like, We've never actually had a world where any crypto OG who has any amount of, ask any crypto OG. I'm so on with Rhino here. While I think it's amazing to, go on FOMO and maybe hit 100x and talk about how great of a trader you are because you got lucky or you were a part of some bundled low market cap meme. Talk to any crypto OG out there I'm talking over 500 coins, 500 Bitcoin. They do not want anyone to know what they have, to know how much size they have. And so if you scroll down a bit, this is also very relevant here. Rhino says, yeah, I've never known anyone who would ever, take advantage of being a wealthy doxed individual that use their false air of legitimacy to commit wrongdoing. That would be absurd. In fact, that's exactly what happens.
Embarrassing.
Exactly what happens. And so while I get the premise of this whole, you need to be showing all your profits and making all your money, I personally would not feel comfortable with $1 million on FOMO or having a ton of public doxed wallets with my main holdings in them. Doesn't make any sense to me. I don't get why anyone would want that. It's just a young, new to money personality trait to want to have all your holdings shown out there and how great of a trader you are because you have money out there that's just I don't know. Real G's move in silence. Lil Wayne was right. Crypto OGs will believe privacy is what matters. I don't want to be on the wrong side of history when it comes to people that are angry because you made a bunch of money on FOMO and you did it in public. Solana outperforming ETH. Solana, baby. Yeah. Interesting. New type. Good to see you. All right, guys, let's get into Venice because I think this is what's happening. This is what's pumping. And I think the audience needs to hear about this. Erik Voorhees and Mark Zeller going back to back to back. Before we do, let me tell you about 1inch. You may have heard this concept of shared liquidity flying around. Products like 1inch Aqua allow you to approve one wallet balance to back multiple positions at the same time across pairs, ranges, and chains. It's a totally different way to keep your liquidity active in more markets. If you want to learn more, check out 1inch.com/Aqua. So our boy Zeller here, who's a notable critic in the industry. Okay, yes, it's a human emotion. Humans love aura farming, new type. Yeah, I agree. And I don't think there's anything wrong with saying you got something right. We've been doing that on the show. We've been right on hype. We've been right on lighter. But I'm not over here posting a screenshot of my, I don't know, multiple six-figure trade profit. I'm banking that. I don't even want my girlfriend to know that. I don't want my mother to know that. I don't want my freaking friends to know that. I don't want family members to know that. So, I don't know, man. I get the aura farming thing, but a wise man once told me that the easiest way to get rid of people is to give them some money. And I think all that you ask by posting your big gains is just having people ask you for money. And that's going to end with them not being your friend anymore. What's the best long-term Solana meme coin to hold? Top 3. Dude, come on. That sentence is just ridiculous. Looked into VV after the open Reddit news, as I think Venice is a genuinely superior product, but I'm sitting this one out. Equity holders own the strategic assets, and that recent round was structured as equity plus token warrants. This means the company can ultimately turn itself against the token holders, I think is what the end of that tweet said. Erik says equity has rights, limited liquidity, and token has rights, limited rights, has liquidity. Some revenues have begun flowing to token. Zero revenues has flowed to equity. Equity is the largest holder of the token, and benefiting the token is one of the highest leverage things equity can do to serve its own interests. Second largest token holder is myself, Giga Whale. Erik is full on post-economic 9-10 figures. We chose to sell/dilute equity rather than selling the token. And so basically there's a lot of skepticism right now around Venice because people don't really know if they should invest in this thing, even though it's the leading AI company in this space along with Near. And they have a really good founder and they have a really, really good product. But this token equity dynamic is just proving to be a problem. They raised $65 million at $1 billion valuation by diluting equity instead of selling tokens. Investors receiving 9% equity plus locked token grants and warrants. So that's the issue, guys, is they sold the token, they sold the investors equity and token warrants so that they get double dipped. And that's what the community is upset about, because when I buy the Venice token, I don't buy Venice equity. That's the big issue. And it sucks that Venice is like the brunt of this token versus equity conversation, because there's so many, let's call them worse suspects of this in the market. So many. In fact, all of them, right? That have operated in the previous regime are suspects. Venice is up 15% today. It's trading at 14.2, up pretty significantly off the lows at 11.75. The market doesn't seem to care. And I don't know if they should. This might be one of those moments that you look back and you're like, wow, the Venice token versus equity FUD was like the generational entry before the next bull cycle of Venice and of the market at large. I don't know if you should care. I know that's kind of like counterintuitive from what we've been saying, but I think they're doing a good enough job. I think they're doing a good enough job. I don't know if you have to care. Like, I really don't know if you have to care that the token and equity complex isn't as dialed as you'd want it to be, because it's far more investable than a lot of the other protocols and tokens in the market. They've got $100 million ARR, 4 million users, completely breakout product, private uncensorable AI. I don't know if you should care. I don't know that you need to care. I think it's a buy between 10 and 14, 10 and 12, ideally. I'm not even sure if you get 10 again. Maybe we get a washout in the space and you get 10. Maybe. I do like the transparency though, because it helps show who's really correct out here. It's easy to say you called something when there's no way to verify it. People love lying about their calls. Yeah, that's true, new type. If you like meme coins, the first cat on the blockchain, Shine says. Not our type. We don't even think you can hold memes long term. I think that's a juxtaposition, or I think that's a weird statement. All right, let's keep it rolling. So Justin Sun is trolling everybody. So HTX is his Huobi is like his exchange, or like an exchange that he has a large ownership in, and well, he is under sanctions in the UK and EU, and so what he's doing is he's sending tiny USDT transfers to addresses tied to Coinbase, Binance, and Hyperliquid just to troll them, just to put them in harm's way. Literally sending what is basically sanctioned tether to these addresses on purpose to either implicate these exchanges or give the regulators a much bigger headache. Isn't that a joke? Isn't that so funny? So Binance and others are literally restricting any activity from HTX linked wallets, and Justin Sun is just spamming their users with tether that's coming from Huobi. I'm upset. Justin Sun is weaponizing regulatory compliance against his competitors because he's in trouble by sending them free money that is supposedly not allowed to be interacted with. Welcome to the bear market, August 2026. This is where we're at. All right, guys, so let's get into BitMiner and MicroStrategy. Before we do, let me tell you about Zama, our premier confidential and computing partner. Zama is building out impressive confidential applications on any blockchain. Visit zama.org to learn more about what they're doing with confidentiality on chain. BitMine is outperforming MicroStrategy by 75% off the May lows. So Tom Lee keeps smashing the bid on Ethereum, and Saylor keeps selling Bitcoin or MSTR to free up his STRC, his stretch dividend backlog. So he's got about $5 billion in cash that is going to be saved for stretch dividend payments. Meanwhile, Tom Lee announced that he was going to start his own similar stretch product. I'm not sure how far he got along with that, but this trade has been cooking. I mean, it is up 75%. And Ethereum versus Bitcoin has been outperforming significantly as well. And so when you start to think about why, you look at the dynamics of these two vehicles, and it's very clear that MicroStrategy is playing a short-term catch-up game where they have to appease various holders of their products. And Tom Lee is literally just T-whopping Ethereum every single week, trying to increase ETH per share of BitMine to send that thing higher. And what's the result? As you see, 75% gain against MicroStrategy. BitMine is cooking against MicroStrategy right now. Tom Lee is in an undoubtedly better position than Michael Saylor right now. Undoubtedly better position. It is not even close. Tom Lee is dragging Michael Saylor right now. Dragging him. ETH Bitcoin ratio looks great. If Ethereum breaks out here against Bitcoin, it will be confirmed high time frame, in our opinion, high time frame bottoms in. Tom Lee's been smacking that chart all around Wall Street. It looks good. It looks good. It looks good. I haven't looked at it in the last couple of days, but let's see what it looks like. Yeah, I mean, it's putting up a fight. It looks good. And they've been notably promoting that ETH Bitcoin chart across all of the BitMine, across all of the BitMine kind of social pages and more. It looks good. Lighter looks amazing too. So, just interesting. ETH looks to have stronger bid, less overhang, less narrative risk right now, and stronger technical structure when priced against Bitcoin, and a better purchaser in Tom Lee. It's interesting. All right, guys, let's get into our daily equity powered by our friends at Denari, talking about the greatest risks in the equity market, which I think is particularly prevalent for us today. Crypto is up, equities are down. Not sure how long that can last. Let's discuss the key risks in the equity markets as it pertains to your crypto portfolio. And then let's talk about the best way to position for crypto for the rest of the year into 2027. Let's get into it. Alrighty, the greatest risks in the equity market are in three places: interest rate volatility because of higher inflation, the carry trade unwinding as foreigners are all max leveraged long AI stocks, the excess leverage that has been pushed into the AI space that has not been unwound. So real quick, before we get into the thread, interest rate volatility. One, the risk here is that the Fed increases interest rates because they're worried about the oil prices due to the war being too high, thus causing inflation to be too high. The carry trade unwinding, which is the Japanese yen versus US dollar carry trade, or Japanese yen across, a number of different currencies. Investors go there, they put this carry trade on because the yen is notably weak, and you can kind of keep it in this range-bound formation, giving you a very low chance of liquidation with a lot of margin capability, effectively to put on this carry trade in size. That would be a problem if these foreigners need to basically sell their AI stocks, go back, pay off their margin in Japan, and unwind their carry trade. So that'd be the unwind. And then three is just the excess leverage, which is investors piling into ETFs that are leveraged on this memory dip. And so if you scroll down, go through each of these tweets here. So here's the kind of like the broader chart. So here's the 30-year real rates. and basically they keep going up. Problem. Yields are going higher. The long end of the yield curve is going higher. Any investor will tell you that this is problematic for equities at large. This means bonds are contracting significantly. Bond yields are increasing. The price of bonds are decreasing. And this is essentially pulling the Fed's leg and saying the long end is pricing the difference of this inflation risk. So that's chart number one. Let's keep scrolling through here. Chart number two is the curve that we just showed you, the long end of the bond yields going up because the bonds are collapsing. The long end of the curve is basically saying that growth and inflation are higher than the Fed may realize, and that without some sort of rate increase, well, this is going to be a problem. Bonds are going to keep selling off. High end of the or long end of the curve is going to keep increasing, and we have an issue here where we need to create a balance where there's an imbalance. So that's what's happening with the yields. Keep going down. So that's kind of like the main inflation risk. And then basically what he's showing here is that what happens when long end rates blow out, which is what's happening. The yield curves are ripping, and the VIX comes back up. Right now, the volatility index is at nearly all-time lows, or very low. What happens when this rips back up? People get a little bit more fearful. Long end of the curve is super high, and we get this kind of unwinding. Well, that's the risk. Keep going down. So that's kind of like the unwinding risk. What about Forex, and what about the carry trade? And so this is a carry trade index of basically the managed G10 currencies, and this all comes back into Japan. You can see all-time highs. It's ripping. It's not supposed to be doing this. Another issue. Keep on going. You have a lot of foreign investors investing in the U.S. And then you've got this negative real rate happening in Japan, where if we get a carry trade unwind, which means that investors sell their U.S. stocks, go back and unwind their Japanese carry trade at the same time as interest rate volatility spikes, meaning that Fed Chair Warsh comes out and says, hey, like, we're going to raise rates because oil is too high. This is the biggest risk. The biggest risk is that you get the Japanese yen carry trade unwinding while you have Fed Chairman Warsh signaling that he wants to increase rates, or he's going to increase rates because inflation is too high. And if you scroll down a bit more, you kind of get to the conclusion here where a lot of these stocks are ripping, keep going down. These leveraged ETFs of Micron, DRAM, SanDisk, storage, cloud, NeoCloud, semiconductor ETFs, they're absolutely ripped. You keep going down, you'll see that on this recent dip of memory, investors actually added to their leveraged ETF positions. That top is they added to these positions on the dip in leveraged ETFs. So now there's more leverage in the system on this move down, meaning investors want to, get more exposure to this, and they want to be bullish. So that's the issue. That's the leverage issue. And so you keep going down, you kind of get to the end here where these are the three clear risks based on the macro flows. They're not boomer speculations. They're directly correlated to how actual buyers and sellers are making decisions. We're not seeing these risks materialize, which is why I'm not bearish. We could move so much higher in a melt up that no one expects. However, this will 100% be climbing a wall of worry because there are real risks that need to be hedged. And so, ladies and gentlemen, the markets are still fragile. This is what is happening in the equities market. These are the three risks that pertain to your crypto investments. If equities have a significant pullback, we will see crypto struggle. Today, what are we seeing? Today, we're seeing crypto perform quite strong, even though equities are down. That will not last, unfortunately. That will not last. We need equities to continue strength to allow Bitcoin to really have a breakout. That's what we need. That's what we need. Ladies and gentlemen, that is a daily equity powered by our friends at Denari. Thanks for being a part of it. I'm going to take a super quick break, and then we're going to get into building a winning portfolio in 2026 based on buybacks, durable revenue, and this new era that we're investing in 2026. Guys, drop your questions in the chat about your portfolio. What are you buying? What are you selling? What questions do you have for me? And we'll get into it I'll see you guys in less than 30 seconds. All right, Freedom Guy, I didn't mean to upset you, man. I didn't know that your question about long-term meme coins was a serious question. I'm sorry. Benjamin Cohen thinks we're on the cusp of an interest rate hike cycle now. Yeah, that would be the nail in the coffin for the 4-year cycle. That would be guaranteed new lows for Bitcoin. And that's what that equity risk that capital flows was talking about basically is like, do we get that? All you need to really buy in a spot is following Lit, Hype, Bitcoin, Zec, buy, spot, and DCA Mansion later. I agree. That's kind of what I'm doing, to be honest with you. That's the plan. That's the plan. All right, guys. Winning portfolio allocation for 2020, 2027, 2026. What does this mean? Why is this important? Who the fuck cares? Well, hopefully you do, because you're an investor. Hopefully you, want to succeed. So let me just start. What has changed in 2026 and 2027 that was not relevant back in the previous eras? Well, we now have a set of fundamentally strong on-chain businesses in this new era that are investable. So back in 2017, 2018, it was extremely easy to invest in crypto. That's when I entered. You could pretty much buy anything in early 2017 on Bittrex and have sold in late 2017 and made anywhere from a 3 to 100x. It was that easy. It was 1 year of every listed token was going to pump, and none of them were any good. None of them were good. They were all just memes wrapped up behind white papers of ICO era. Fast forward all the way through 2017, 2020, 2023 to where we are now. We went through this whole iteration of high FTV, low float, L1s, L2s, infra. Where we've got is ironically a similar place to 2017 and 2018. It is now, I believe, just as easy to invest in this market as it was back then. But it's the opposite. It is not buy anything and it's going to 3 or 100x. There's only so many businesses worth investing in. The investable pool of assets in the space has shrunk so much that it's simpler than ever to pick the right tokens for the next cycle. Here's what I mean. The leading assets for the next cycle are going to be the ones that are highly fundamentally strong, have revenue producing on-chain businesses, and pay investors or token holders in the form of buybacks. That is undoubtedly the recipe for success. Excuse my zin. The leaders of the fundamentally revenue-producing on-chain business era of the next cycle will be the tokens that you can buy in this second half of 2026, Q3 2026, Q4 2026, and hold through 2027 for long-term capital gains in your jurisdiction of choice, and sell in 2028 for a massive win. It is, I believe, that simple. So I'm going to pull up on the screen here the suite that I put out, the new leaders of the fundamental revenue producing on-chain business era of the next cycle. And I think it is this simple. I think it is this simple. I think it is as simple as this. And so you can see here the new leaders of the fundamental revenue producing on-chain business era of the next cycle. Hyperliquid, Circle, Polymarket, Pump, Tether, Ledger, Near, FOMO, Arrow, Derive, Relay, Aave, RE, EtherFi, Uniswap, Frax, Variational, Chainlink, Morpho, Sky, Or. I probably missed Venice, probably missed Pendle, and maybe a couple others. Guys, you can shorten this list based on which have tokens, and you can already take off FOMO, Tether, Variational, and a couple others maybe. You can shorten this list to 5 names, and you can allocate your portfolio into 3 in size outside of your core major holdings, right? So you got your Bitcoin holdings, you got your ETH and your Zcash. You got your store of value assets. Whether you want to put ETH in that bucket or not, that's up to you. But you got your Bitcoin, you got your Zcash. Those are your store of value assets for the cycle that have, God knows, the upside. And there's no revenue we have to argue about. There's no adoption metrics we got to argue about. We just need to hold them for as long as possible and endure the volatility of those 2, maybe 3 Ethereum. And that's kind of like the store of value barbell. And then the other barbell is revenue producing on-chain businesses that have really strong buybacks and treat their token holders like first-class citizens. Hyperliquid, one of my biggest ones. Pump is now in that for me. And we talked about yesterday, when the doubters of the revenue become believers, you get these massive re-ratings. That happened to Pump. As of late, I don't think it's over yet. I don't own Circle in the equity market. I think it could be interesting. And you can just go down the list, right? I don't have equity in Polymarket. Don't have equity in Tether. I own Lighter. I own Near. Don't have equity in FOMO. Arrow, Derive, Relay, Aave, right? And you can kind of go down this list, and you can see different revenue metrics, and you can see different market cap valuations. You can apply your own mental framework to picking from these names. I own EtherFi, right? I own Chainlink, right? Morpho might rip. Sky is doing just as much revenue as Hyperliquid the last, this week, but is valued at 1/25th. So guys, while it's not 2017 or 2018 anymore, and it's not like you can just shoot fish in the barrel with a nice little bow and arrow, it is about as easy to invest in this space if you can just get through the rest of this year. Midterm years are typically pretty bad for crypto, and you can think about your long-term capital gain strategy with high quality assets, with a barbell of store values, Bitcoin, Zcash, maybe ETH. If you really like it, I think it could have a massive run. And then revenue producing on-chain businesses that treat token holders like first-class citizens. What you want to avoid is everything in the middle. The bloated infra with no users and no revenue, the old taste of L1s and L2s with no real revenue or no real tokenomics that are, beneficial. The, big unlock hype narrative tokens, the old tokens that have no real product or business. You want to avoid that fluff in the middle. and you want to stick to the store of value assets, and you want to stick to the revenue producing on-chain businesses. Bitcoin and Zcash, unlimited potential, less of a floor, right? Higher ceiling, lower floor. These revenue producing on-chain businesses perhaps have a lower ceiling than a Bitcoin or a Zcash or an ETH, right? You can't really say that, you know, I don't know if Hyperliquid could ever get to $1 trillion market cap, right? That would be unreal, right? It's a business. It can always be measured on cash flows, right? You know, I don't know that, but can something like Zcash get to 500 billion without an explanation? I think so. Something like Bitcoin get to 5 trillion without an explanation? I think so. So you see, like, the store of values have a higher ceiling, but can Zcash or Bitcoin go from their next cycle highs down? I mean, specifically Zcash down 85%? Sure as hell can. Can Bitcoin pull down easily another 75? Sure as hell could. However, with the revenue producing tokens, you could argue that they may not be able to reach the trillions or the extra inflated market cap, because you can always apply a PDE ratio on these things. You can always have a cash flow based valuation metric. But are these things ever going to trade? You know, is EtherFi ever going to trade at, you know, under 50 million again? No, it makes that in a year, right? Or is Hyperliquid ever going to trade, you know, at less than, you know, 12 to 15x earnings? It makes $1 billion a year? Well, probably not, unless something catastrophic happens. And so with these revenue producing on-chain businesses, you kind of get a lower ceiling, but a more, I don't know, you know, a more steady floor, because there's always a value investor willing to come in and buy that thing when it's undervalued based on cash flows. And that is what I think is the winning portfolio structure for 2026 and 2027. It is the barbell between a store of value asset portfolio and a basket of your favorite fundamental revenue producing on-chain businesses. That is the winning portfolio allocation for 2025 and 2026. What about stocks, BLSH, Galaxy, Hood, Coin? Yes, great question. Totally agree. I think stocks could easily be a part of this. We have Circle in here. We might see a Polymarket IPO. And those all make money and can be a part of this revenue producing businesses. So I agree. Galaxy, Hood, Coin, BitGo, etc. I think you know, Circle, Coinbase. I think that could be a part of your revenue producing on-chain business kind of category, and I think that they will do well. Canton, Or, Jupiter, Geode, Solana, Cake, all are in the top 30 for token holders revenue in the 30-day rank in DeFi Llama. Yep. I missed a couple. How do you guys have 24 live viewers for this high quality content? Bear market in full effect. Love the buyback equity topics you guys are discussing. Very decent information. Thank you. I believe we're at 40 concurrent right now. The bull is coming. Thank you, Luca, for the shout out. Just give it time. These guys will be huge someday. Honestly, I see the team from Blockworks acquiring or hiring Andy and Rob. This guy New Type's funny, man. Little Miss Gunn says, Rocket, I'm glad you're here, Miss Gunn. Great to always have you. I bought a small bag of XST on Phantom for some bull market fun. Have you ever heard of it? New Type, that is for you, buddy. I will leave the DGen Freedom Guy content to you, sir. Guys, we got our first guest in the building. We're going to get him up. We're going to be right back. Give us about 2 or 3 minutes, and we're going to get the show on the road. Thanks for rocking with us. Hope you guys enjoyed that segment. I'll be around for more questions and comments on portfolio stuff after our guests. See you guys in just a sec.
We get deep. We get deep. You know we get deep. We get deep, you know we get deep. We get deep, we get deep, you know we get deep.
Yo, what's going on, guys? This is Etan with The Rollup. We're going to be patrolling the streets of New York City, getting answers to the questions that you guys have most. What are people trading? What are people investing in? How much do people actually budget? We're gonna have people from all over, all different investment classes, people who are dead broke, people who are dead whales, people who are just loaded. There won't be a mayor or politician to stop us on the streets. We're going to go everywhere, all 5 boroughs. We're taking over the 212.
Alrighty, guys, we're live here at the Nest with Harry. Harry, good to have you, buddy. Welcome to the show.
Thank you for having me.
Yes,
Sick
sir.
office, great production.
Thanks,
Always
man.
nice talk to you, man.
Yeah, man, it's good to see you in the city. I'm sure you're busy doing meetings and talking to market makers, investors, friends, family, etc. So good to have some time with you here. And I understand you guys are getting active on Robinhood chain,
Exactly.
which is quite the hot topic as of the last month. I mean, they came out of the woodwork and they're dominating all metrics across L2. So crazy launch.
Yeah, absolutely. I think there are several reasons why they are doing so great, and I think this is only just the beginning. I think the reason why we chose Robinhood Chain was, I think, mostly for business reason, I would say. Technically, there are sound that are using the Arbitrum stack, so it's absolutely green flag. I think on the business side of things, what I've been pondering for a very long time, there's one business concept called aggregation theory. It's basically about like every successful internet business or durable business that can last for decades. They always aggregated demand and the supply kind of commoditize around that. And if you look at the crypto for last decades, we're kind of like building that backwards. So you have the chains, you have the supplies, you need to incentivize the users, you need to do their jobs, the TVLs and incentives and all that, just so that the people can come in and use your application. And if everything works out, they stick with your chain, but most of the time they are just a mercenary. The reason why is that they are, as an industry, we're kind of like building around the supply first. We're aggregating the supply first. Now the block space is very cheap. Instead of doing that, I think it's probably just going back to the business school concept of the aggregation theory. Instead of just aggregating on supply, you just aggregate on the demand. Who has the best demand aggregation vehicle in crypto right now is basically Robinhood chain. Like they have probably like close to 30 million funded users, and any single one of the users are directly translatable to their on-chain applications nowadays. Yeah. So that's, I think it's a very exciting time to be, and that's really the most important reason why we are choosing Robinhood chain right now.
Yeah, man. And so what is it that struck you about, wanting to launch this product, and kind of what is this product on Robinhood chain? Why is it needed? Why are you guys launching this there? What is the nuts and bolts of the Mobius exchange product on Robinhood chain?
Yeah, exactly. So I think the one sentence pitch is basically that Mobius, or Mob Exchange as we just rename it, is basically a margin and our engine for all on-chain asset, specifically tokenized stock. So I think our thesis is basically that, historically speaking, every new asset, when you move on to a new settlement rail, there is going to be a credit layer on top of that. And we are basically the credit layer on top of that. If you look at the Eurodollars, like ETFs, historically speaking, there is basically, you need a kind of this financing layer. So now we have basically the tokenized stock that's moving on chain. And instead of just trading on the Robinhood applications, now you can actually trade it 24/7 instead of just 28% of the time of the week. Yep. And then now you can add leverage on top of that. You can trade it on Lighter, you can trade it on Hyperliquid, all this leverage engines. So to the retail users, I think it's just by itself, like even without our product, it's very attractive to people who want to trade already. And on top of that, what we're trying to build is a cross margin layer. So because there has been a proliferation of perp dexes out there, the user interfaces are fragmented, the liquidity are very fragmented. Yep. And if you want to do cross margin trade, you can only do that on one single exchange like Hyperliquid or Lighter. Wouldn't it be nice to cross margin your positions across the different perp dexes? Yeah. Right. So that's basically how it really came about. So me personally, I had run my own strategy since I got into crypto, and my favorite strategy is basically the basis trade. Like you can carry the spot asset, you can short the same asset on a very liquid purpose exchange. So now you can actually do that on Hyperliquid, on Lighter, and on top of that, if you really, I would say it's probably carry trade on story is basically the funding rate arbitrage. You can funding rate arbitrage across the different exchange. Yeah. This has always been the go-to strategy for hedge funds who operates in crypto, but it's never been made accessible to the retail users. Right. The reason for that is because there is no infrastructure support for retail to do this kind of trade. Normally, the institutions do this through prime brokers. So they have their credit account, they can borrow the credit, then they're essentially 10 times more capital efficient, if not more so than the retail users. Yep. So through our product, we have the infrastructure for every retail user basically to do the same. You can do funding rate arbitrage across the different perp dexes. You can long short same assets on Hyperliquid, Lighter, or Robinhood Lighter, a main Lighter, or whatever perp dex that we're going to integrate.
And so just to kind of like round it out. So I come in, I got $10,000 of USDC. I come into Mobius and I want to put on a position that is a kind of a cross venue strategy.
Yeah.
And so I deposit the capital into Mobius, and it is entered into a strategy on my behalf, similar to like a vault, or the platform is essentially, I'm able to then go and leverage my capital across multiple platforms on my own with like using my own strategy. Like you guys are providing the strategy, or I am providing the strategy?
That's a great question. So we're actually doing both.
Okay.
So we provide the infrastructure, like I think we covered that. We provide the infrastructure for that. It's totally built on top of the TEE because we basically want to build a very trustless version of that. And we actually enable two different modes. So the first mode, it's a self-directed strategy, meaning that if you go to our website, it's live now. You can go there, you can see that it's basically a trading front end. You can get connected to different trading venues. Then you can actually launch any strategy that you have, running your own customized strategy, depending on your personal risk preference. And we'll later add a bunch of other like supportive features, like we help you to rebalance the position and all that. So that's basically the self-directed aspect of the product. The second part is basically a yield product, which is exactly a vault. For people who doesn't really want to manually manage their strategies, they can basically put the money into the vault, and we really run the strategy for you. And eventually, we're going to make it permissionless. So any team that's running successful strategy can come into the platform and spin up a vault and use our infrastructure to do any kind of like a cross-margin trades.
And so active today on Robinhood Chain, users can get in there and deposit into the vaults that you guys have already established. Any amount is, one USDC, 100,000, $1 million, doesn't matter.
So one caveat to that is that the vault is not live today yet.
Okay.
We're testing. I should say that it's live internally. We'll be running the vault for ourselves for a couple months, but the contract itself is currently undergoing the audit.
Yep.
So the vault product should be live if everything works well. Should be live around September, mid-September.
Great.
So by then, like, there's really no upper bound or low. I guess that there will be an upper bound in the very beginning. We can't just really handle like super massive trade. Like we can't rebalance position that's $1 million at one time. So there should be an upper bound, but there should be no lower bound. Anybody can just put in money.
And the thesis from the business side is it just a fee on AUM type of business model? How do you guys think about scaling the kind of business line of launching this product?
Yeah, I think on the business side of things, like historically speaking, I think in crypto in my opinion, there are only two ways that can make sustainable revenue. One is through trading fees. The other is more balance sheet driven. So the first one is basically any exchange is like trading fee driven, or any roll up is trading fee driven. Like you just charge a percentage of the user's fee to your platform. And the balance driven part is basically any lending protocol, any stablecoin protocol, you just take a fraction of the yield. So actually because of the nature of our product, we're actually doing both. So on the trading side, because the user you can do it, just trade on Hyperliquid or Lighter or open your self-directed strategy. So we charge a fee on that, on top of that, very small fee. Or on the Vault product, it's just more balance sheet driven. We run the strategy, you put in the money, and we generate yield, and we take the percentage of the yield. So it's two very simple, sustainable business model.
Yep. Yeah. Awesome. Yeah. I mean, this entire kind of like Vault complex has really started to grow and expand in terms of use case, and people are really trying to get like a lot of the institutional allocators interested as well. Different types of strategies on chain 24/7. When it comes to the beauty of using something like Lighter or Hyperliquid, what is it about these venues that allow you to kind of execute your strategies seamlessly? Like, what is it about Lighter's instance on Robinhood Chain that is, obviously they're still kind of growing their OI and liquidity there, but what is it about these perps venues that kind of enables you to crack different types of yield generating strategies for your users?
Yeah, I think the two platforms that we currently integrate are Hyperliquid and Lighter. I think no surprise there. They are the best out there. So each have its own strength. Hyperliquid being the first, kind of the first. DYDS technically is probably earlier in that, but like in my opinion, the first successful perpex is Hyperliquid. They have been there for 2 years, 3 years, I think. They have a loyal community. So as such, they have probably the best liquidity out there. Lighter, as the latecomer, I think they have all their all you need to really take on this challenge. So they have an amazing team, and the product-wise, one thing that really I personally really like is zero fee. There's no taker fee, no maker fee for regular users. So if you are doing any kind of a market making strategies, like I personally run market making strategy across the main lidar and the Robinhood lidar. It doesn't really matter like maker orders, taker orders. There's no fees unless you want some like a latency advantage. But my strategy doesn't really require that. For the product that we build currently, we don't really require any latency advantages as well. So it's a zero fees, I think lidar only charge fees for premium accounts, which is like professional market makers. At the expense, that's kind of like the trade-off they make. Like for a better user experience, and for basically essentially zero trading fees for users. So I think that's a huge advantage. Any products that want to attract the retail users.
You know, I'm curious to get your opinion just from the block space and kind of understanding the trenches of how a lot of these strategies works. Perp stexes, but also this concept of prop AMMs has been really, really glorified over the last several months and also implemented. I'm sure you remember that M Team guy, the young buck.
Yeah, absolutely.
I think they just launched a product called Bye Bye.
Bye Bye, yes.
I know Fede and the Lambda class team are cranking hard on prop AMM products as well for Ethereum.
Yes.
Just kind of a update there, lay of the land. Like have we seen success? Have we proven the model? Is this the go-to? Like from your understanding and expertise around block space, around Ethereum, kind of what's your honest view of the upsides and downsides to this prop AMM concept?
Yeah, I mean, like I've been following along, like what are the latest products? I dabble with. I think there's been a very popular challenge by like Dan Robinson from Paradigm, like called like probably AMM challenge. I dabbled that as well. I don't have a very strong opinion because I'm probably not very educated on the latest stuff. But in my opinion, I could be wrong. Like just don't yell at me. but I feel like it's essentially RFQ. It's on-chain RFQ.
It's an RFQ. It's an
on-chain RFQ system, and you can't do this on-chain on Ethereum mainnet, for example, in a very slow manner because this is the block time slow, the low throughput. But you can do this on Solana or Base or whatever. Basically, you just need to figure out like your curve. So that's how the mechanics of it, how it works, and I think I don't think technically it's a very new thing compared to the old RFQ model. But what the Bye Bye is doing is very interesting. Is that they actually have their own front end, and I tried that personally. It's a really good front end, but
it's almost like you can just type what you want.
Exactly.
Yeah, that is cool.
Yeah, so analogy of that is kind of it reminds me of the early days of 0x because 0x starts out as basically an RFQ service. And then later they'll launch a Matcha, which is basically a trading front end.
I remember.
So Bye Bye could be like a combination of the both. But what exactly is the winning strategy being a prop AMM other than getting a large amount of order flow? I honestly don't know. I don't have a very good answer for that.
Yeah,
but it's a very interesting space.
Are you a lighter bull? Are you a LIT token bull?
Yeah, absolutely. I'm farming that right now. So we're building product.
Oh, on Robinhood chain, right? The points just launched.
Exactly.
Yeah. 11 million tokens up for grabs.
Very exciting time. Very exciting time.
So you're bullish.
Very bullish.
You see Hyperliquid obviously explode, and you see Lighter as like the 1 and 2 punch there.
Yeah, absolutely. I think I see Hyperliquid has been dominating for 2 years at this point. I want to see someone that can really not taking its place, but to be a very capable competitor.
Right.
Lighter has all he needs to be that.
Yeah. And as far as some of your own other portfolio holdings, like still bullish Bitcoin, ETH,
still, even though like I
bullish ETH, right?
Yeah, I'm no longer. It's maybe more for nostalgic value because of this way I started. I still like the people from Ethereum Foundation and the people who left the Ethereum Foundation still very much working within the Ethereum ecosystem. So I hold ETH for nostalgic value. I support that, but I would say Lit, ETH, are basically two of my biggest holdings.
Yeah. I mean, Lighter is like the best example of what Ethereum can provide to an on-chain app.
Exactly.
Like ZK proofs, latency, roll-up centric, roadmap, like exemplary, just example of what you can build on Ethereum.
Absolutely.
Yeah.
Absolutely.
Yeah. What about like the whole like Zcash privacy stuff? Is that interesting to you at all?
I think honestly, this is probably a very bizarre angle, but I'm gonna just say it. Like I lately have become so interested in compute market.
Okay. Like the financialization of compute.
Yes.
Yeah. Okay.
And then there's a very niche problem. I think that some people brought it up, but more on the AI side of things.
Yeah.
Which is how do you aggregate GPU hours?
Okay.
So there has been a lot of index products, so like Silicon Data, or and I actually don't know how to pronounce that, but like those are the top two like computing index products.
Yeah.
They say that hey, we aggregate a bunch of like compute hours, and they use data to generate the index product on top of that. And exactly where do they get those compute price, like the supply and demand price of that, the transactions? It's a very much hidden.
Yeah.
For good reasons, because larger suppliers don't actually want to disclose their quote. It's very much like RFQ, like in crypto. So the compute, the hours also an RFQ system. They just want to throw it out there. So it's a hidden. It's very much hidden. They probably have some kind of like contracts in place that they aggregate the data from this new cloud, large providers, and they are able to generate the index value. But if you can actually have, I'm just wondering if you can have some kind of like a privacy layer where you can guarantee that this the data that you aggregate is reliable.
Yep.
And it's from like provider A, B, and C. They don't have to disclose that. That's their price.
Right.
If you can aggregate that data, generate this value, that's trustless, verifiable. I think that's definitely an edge there compared to the existing providers, which kind of, in a way, like I can't really find how they aggregate their data.
Yeah, that's the beauty of perps, and the beauty of on-chain is that you can get these 24/7
exactly
derivatives markets for things that maybe previously wouldn't have existed.
Yes.
So the rise of compute markets is like directly correlated to the success of, I think, Hyperliquid and Lighter.
Yeah.
Like I'm sure NASDAQ and Kalshi and CME and all these are going to launch futures and things, but this is going to become another perp, 24/7 tradable contract globally with no KYC. I mean, it's just hard to like argue that. I mean, the NASDAQ can launch 24/7 trading. They can do it as much as they want, but 24/7 global, no KYC on anything. It's like, okay, like, so we're in a good spot. So I know we're kind of short on time, Harry. I think you may have brought the team here something special as we kind of come to a close, man. But just kind of give us what the roadmap for Mobius looks like for the end of the year into early next, and kind of how you're thinking about that.
Yes. So like I said, we have like two main features. One is the trading feature. For the trading feature, basically what we're trying to do is integrate as many perp dexes as possible, whatever the user wants. You want to farm the point, you want to do the volume rate arbitrage, you want to do the basis trade. Join Telegram channel, just let us know if you want us to integrate this particular perp dex, we'll do that. It's very simple. It probably take 3-4 days for us to do that. So integrate as many perp dexes as possible for the front end, then launch the vault product. So the first strategy were basically very simple: spot BTC, then short perp BTC, a Lighter. The second one is going to be more interesting because we're going to dabble with tokenized stock. So likely SpaceX or Tesla or NVIDIA, whichever one, or maybe a combination of them.
Yep.
Again, basis trade. We hold the spot on Robinhood chain, short the perp on the Lighter. So those are the two the vault product we're going to launch before the end of the year.
Yep.
So I think that's kind of like TLDR about what you're about to see. And join our Telegram channel. Yeah.
Well, thanks for joining, Harry.
Yes.
Appreciate you being part of the show. It's good to see you in the city.
Good to see
pull
you.
this up for the gang here. Yeah. Looks like old Harry may have brought the lovely ladies and gentlemen of the roll up some wine.
Yeah, it's a white burgundy. It's a housewarming gift. It's the first time in this office. It's a beautiful office. If you ever get
Check
an
this out,
opportunity,
guys.
come here.
Yes, we're gonna get this little open here, and Might have a little office happy hour tonight.
Absolutely.
W's in the
Check this big guy out. Wow, it's a bomb. Absolute monster. Monster of a wine here, guys. Look at this. Rare Wine Corp. Check that out. Check that out. Bang. Look at this guy here. Appreciate it, man. Wow. Look at this.
You like it.
It's wrapped like a Christmas gift. Bang. Wow. Borgioni Aligotti.
It's a great white burgundy.
Wow. This thing's a tank. Wow. What are we going to do with this? Guys, what are we going to do with this, huh? Look at that. Thank you so much, Erik.
Thank you.
Beautiful. Alrighty, guys. We'll be back with more wine, more guests, more charts, more news, more markets. Back in just a second.
We get deep. You know we get deep. We get deep. You know we get deep. We get deep. We get deep. We get deep. You know we get deep. We get deep, you know we get deep. We get deep, we get deep, you know we get deep.
Yo, what's going on, guys? This is Etan with The Rollup.
Alrighty, guys. How about that? Wine for the boys and the girls here of the Rollup headquarters. Give it up for our lovely guest, Harry. It was amazing. Great to have that. Good conversation. Been a longtime supporter, friend of those guys. So, guys, we've got a institutional mega powerhouse, Anant Kumar, coming on to talk about the tokenization mega trend and more. So this is kind of like the other side of the barbell from what we're talking about, right, guys? So like you've got this like mega trend happening in tokenization, And it's very obvious. Anant is the managing director and global investment strategist and the head of U.S. credit research and portfolio manager at Benefit Street Partners, Franklin Templeton's private credit platform. He joined the firm in 2015 after roles in capital markets advisory and Lazard Freers and leverage finance at Deutsche. Kumar holds an MBA from University of Chicago, an MS from Stanford, and a bachelor degree from Vivesivada Technological University. That is 3 more degrees than I have. That is a good sign that this guy's going to be intelligent. But ladies and gentlemen, let's get Anant up on the show. Let's get the show on the road. Anant, welcome to the show, man.
Thanks, Andy. Happy to be here.
Yeah, man. What a time. I mean, just to set the stage, right? I mean, tokenization mega cycle. I mean, we call it a mega trend. We call tokenization stablecoins perps. And you can kind of squeeze vaults in there now. That there's a lot of excitement about them. But you got like these 3 mega trends kind of defining what we're calling like the secular exports of the digital assets industry. In this bear market time, we try to find things that we're actually doing well. And tokenization happens to be one of them. So I'm just curious from your perspective, just how this whole kind of journey into this tokenization space has unfolded, and maybe just how your perspective on this has changed as you've started to work deeper and deeper into this kind of tokenization space. I understand that you are working very closely in the private credit sector. And so maybe just give us kind of like your perspective to start us off, just to have some context.
Sure. So, I think tokenization is definitely the wave of the future, and we're going to have many different assets that are going to get tokenized. The big unlock has come from the regulatory regime changing and becoming much friendlier. So the TradFi world is now adopting tokenization. You see the big institutions that were calling Bitcoin a pet rock and having sort of pejorative connotations around anything crypto related are now adopting this very broadly. So I think this is a secular change, as you put it, and TradFi has seen that this is a trend that's coming, and they're reorienting their systems to take advantage of this. And this capital to be raised in the space. So whenever that happens, everyone jumps on that train.
Yeah, most definitely. And so when you think about the lines blurring, right, between the traditional finance world and kind of what's happening in the on-chain world, through your conversations with your colleagues, with your friends, with your network here, has there been a serious perspective shift or a serious understanding of the inevitability of something like tokenization, of something like these worlds kind of colliding and merging? How much pushback are you seeing? How much kind of anti-tokenization, anti-blockchain rhetoric still exists in your kind of inner circles?
So I think, look, there's always going to be, 5 or 10% of the population who are, I won't call them dinosaurs, but, people who just are resistant to change. But the vast majority of people have realized that once the big institutions, you've got DTCC, you've got the regulators, you've got the JP Morgans of the world, once they've all jumped on this train, there's a lot of momentum behind it. So there's not that much resistance. And I think the best example of this was actually what happened last month with JPM, posted QQQ as a collateral at the CME in a tokenized form. And that's just, that's not something you would have said, 5 years ago, where, JP Morgan was somewhat antithetical towards the whole idea of crypto. They always liked blockchain, but I think them demonstrating that this is not just a project or some research lab, this is real world, that's just changed the conversation, and everybody realizes that this is something that's inevitable, this is coming. And it wasn't just JPM, you had BlackRock, Goldman, Vanguard, everybody was involved in this initiative. And to me, that's one of the most exciting applications of this. It's that collateral layer. Because, I come from a credit world, and collateral is really, the heart of what we do. If something goes bad, you seize the collateral. So seeing collateral being tokenized is amazing. And, the other benefit is the world I come from. We do private credit, we do loans, we do bonds, and settlement is a real issue. Now, settlement has become an issue that's been solved mostly in equities. It's T plus 0. In bonds, it's T plus 1. But in loans, this is a real problem. If many of your listeners might not be aware of this, but when people are buying and selling loans, leverage loans, the settlement process can take 15 days which is crazy. And the way it's done
Really?
is it's you pick up a phone, there's some PDF somewhere, the bank's closer chats with your trader and they figure out the settlement. That process takes 15 days. If those loans can get tokenized, that can be atomic settlement. So to me, the two things that I really focus on in my world are collateral and settlement. Those are the two easiest things. There's a whole host of other applications, but if we get those two right, there's such a big unlock. And that's why people are excited about this, even in the TradFi world. And a lot of the resistance has sort of gone by the wayside because they've seen the benefits this can provide.
Yeah, man. I mean, the collateral thing, just from our world, if you will, we saw a couple popular perps venues offer using the tokenized S&P 500 as collateral for cross margin on chain, right? So cross margin your stock holdings and trade crypto, commodities, gold, et cetera. There's just all these little interesting little nooks and crannies of financial innovation or engineering innovation happening. When it comes to the loan side and the collateral side, I think Bitcoin has probably become a collateral asset. I think Ethereum has a ways to go. I think other crypto assets aren't really close to being there yet. But for, a risky investor, if you want to put your Bitcoin into a collateral or into a loan and collateralize it and borrow against it, I think with some understanding of how Bitcoin cycles work and a reasonable allocation to this part of your portfolio, it's perhaps a smart thing to think about doing. And so as Bitcoin becomes a preferred collateral asset, right, it's got really nice liquidity parameters, it's got a 24/7 market, it's got decent depth. How do you expect this to affect how do you expect to kind of see institutional borrowing and loan provisioning against a collateral asset like Bitcoin? How does that differ, or how's that similar to, I don't know, borrowing against gold or borrowing against a house or borrowing against a loan? How do you, yeah.
Yeah, so I think Bitcoin is the perfect asset for
Really?
asset-backed lending because a few reasons. One, it's there's a clear public ownership chain. A lot of times, people have collateral and they post collateral, but you have to go and investigate who owns the title to that. Like, does someone really own it before they post this collateral? And you can have fraud around that. With a public blockchain, you know exactly who owns the collateral, right? It's publicly visible. That's one element. Second is the obvious one, is atomic settlement, right? In the traditional world, when you post an asset as collateral, you have to get a lien on it, you have to get title to it. And if there's a bankruptcy, then there's a complicated lawsuit. And if the liens aren't perfected exactly, then you have trouble getting the asset back and seizing the asset, right? With Bitcoin, you can put it in a vault, it's programmatic, and once an event occurs, you just transfer it instantly. So it takes away a lot of that noise. And the third element, it's so easy to transfer, right? So you talk about gold. If somebody posts, $500 million of gold somewhere, I have to go physically collect that gold from a vault. Like, good luck with that. The security alone for that, right? Bitcoin, it's secure. You can get it instantly. It's atomic settlement, and it's publicly available. So if I were to design from scratch an asset that would be good for asset-backed lending, like collateral, I think Bitcoin or just any sort of like blockchain-based token would be perfect. And Bitcoin is great because there's no one who owns it. There's no sort of central governance there. Anybody can change the rules. So I mean, it's the perfect asset.
Bullish. Yeah, I mean, I think the construct from the investor perspective is being able to be long-term bullish Bitcoin without having to sell, being able to leverage, some sort of LTV ratio and being cognizant of your risks and being able to kind of pull cash from the investment without needing to sell. That's kind of like the long-term bull thesis, obviously, for this model. Another thing that you guys did recently, or from what I understand from Franklin Templeton's side, is this commercial paper deal that you guys executed on Solana. What even happened there?
Sure.
And what was it easy to do? Was it hard to do? Was there operational, regulatory hurdles, risks? What happened there, and how easy was it?
Okay, so it was the first time somebody was doing something like this in the kind of vehicle we did it in. So there was a little bit of, we needed some legal opinions. We needed, the auditors, everyone to sort of opine that this is okay to do. But once we had those opinions, it was relatively easy. We just set up a wallet. And then it was, and this is publicly disclosed, it was Galaxy was the firm. They issued commercial paper on the Solana blockchain. This was facilitated by JP Morgan. We were one of the firms that participated in that, and it was commercial paper. It was 3-month paper. It's already been repaid, so that transaction is done and dusted. But it was a really good way to check the rails. For me as a lender, I was just underwriting Galaxy, right? We know Galaxy. We lend to them in various capacities. This was just another one of the instruments. And I think commercial paper is a good place to start because it's such short duration that the risk is really not, the tenor is 3 months, so there's no real risk over there. But then that's going to extend, like you'll extend to ABL, you'll extend to unitranche financing, and there'll be an extension of that over time. But that was a perfect test case. It was like a 3-month instrument. We tested on Solana's rails, and JP Morgan facilitated it. So once we got the legal and regulatory opinions, it was very easy.
And what is the value of doing that versus like the other way to do it, or like the normal way to do it?
Well, the biggest value is the cash and sort of security move at the same time, right? You settle instantly, so there's no big process. It's just everything just moves atomically. That's great.
Right.
And you can be very creative with this. It's as you know, blockchain is programmable money, so you can put all sorts of controls and rules around it. So to me, like the first two things I mentioned, like the boring parts of the finance plumbing, which is collateral and settlement, those were like the good ways, the good benefits of doing that deal on the Solana blockchain. And by the way, we could done on any other blockchain. It's not particular Solana, but Solana was a great blockchain to do that on.
Yeah. And then Anant, kind of more into your wheelhouse here, specifically around the private credit side. What have you guys been doing on that front, bringing that on chain? And what does that what does that look like?
Sure. So I think the thing that people focus most on is the tokenization of funds, right? So you have these private credit funds that have been tokenized. So traditionally, you would go to your broker and you would put a request in for a fund. Now that same fund can be on chain, right? That's great. The problem with that has been adoption, because the challenge is distribution, right? You can tokenize a fund very easily, a private credit fund very easily, but getting the distribution, finding people who have the wallets and the infrastructure to invest in it, that's been a sort of the gating item. So we've seen firms that have tokenized their funds, but the dollars raised there haven't been that large. We're talking about sub $1 billion. On the other hand, if it's a money market fund, those have been tokenized. Franklin Templeton has one called Benji. We've raised billions over there. So that's been a little bit easier. But on the private credit side, the adoption has been a little slower because of that distribution bottleneck. But that's sort of the headline. The thing I'm most excited about when it comes to private credit is, I'll take a step back and explain. So with private credit, there's two problems. One, there's no liquidity, right? These loans don't trade. And two, there's a constraint on who can trade the loans. So the issuer of, the borrower, the person who borrows the money, they actually have their owner, the private equity firm, typically, they have a say on who can trade the debt. So they can say, you know what, we don't want this holder to buy our loan. And they actually have a say in this. So these are the two problems. Now, tokenization can solve both those problems. One, you can have a situation where you have a permissionless token, and I know that's a bit of a leap of faith because people won't really like that, particularly the banks. But if you can tokenize a private credit loan, then anybody can own it, right? You're still the lender of record, but you can like farm out little pieces to anyone. So then that question of the private equity firm saying who can own their loan or not, that goes away. That's one big problem solved. The second problem is liquidity. These loans do not trade, right?
No.
And you may have read the headlines about a lot of private credit funds having redemption requests, and they need to sell assets to meet those redemption requests, but there's no secondary market. If you create a token, maybe create a digital twin of the loan, and you represent an ownership interest in the loan, and it's a small piece, it's not the entire loan, you can create a liquid market around this. So you can unlock two issues with private credit. Now, there are firms that have tried to do this, and I know there's headlines about some firms that have had some success. It's still very nascent. But if we as an industry can solve this problem, I think that's going to be a huge unlock.
So I think it's really cool, for example, that we are getting compute markets and compute derivatives on chain, on perps platforms. It's basically like one of the things that blockchain is amazing for is that you can permissionlessly create markets based solely on supply and demand by a buyer and seller on perps, no underlying, purely 24/7 perpetual future contracts. Similarly, in this regard, what another kind of like kind of subsidiary or secondary effect is that you can create secondary markets for a lot of like basically non-liquid or illiquid assets off chain. And so you're basically saying that we can perhaps solve some of the illiquidity crunch issues through that the private credit industry is facing by potentially tokenizing some of these loans or you know, some of these books. Two questions. First, how is this not just like making normal people or less educated folks or folks who are just kind of interested, how is this not making just people exit liquidity to the problem of these investors who are in these instruments in the first place? And then second, doesn't making something that is only marked to market once a year, once every 6 months, doesn't make that, or once a quarter, doesn't making that liquid kind of reduce the illiquidity premium attached to that asset? Like it's kind of a facade in a sense that it's like, oh, it's illiquid. This is the price. It's at 100. It's at 100. Well, you know, maybe it's not. So doesn't that kind of place more potential risk on the industry itself to actually have kind of the curtains opened up as to like the actual liquidity of the asset and thus kind of like lower the illiquidity premium, which I know sounds backwards because typically there's like a liquidity premium. But in this case, it seems like the lack of marking these private credit instruments to market allows for them to kind of sustain a higher or a more steady, let's say, nominal value than if they were marked to market like every block, every second. So, you know, how are we not just creating an exit liquidity here, and how do we kind of navigate the liquidity versus illiquidity dynamic?
Yes, that's actually a really insightful question. I'm almost confused. Are you a TradFi guy? Because that's the kind of thing that the TradFi guys would ask about.
Certainly not. College dropout.
So you're right. There is an illiquidity premium with private credit because there is no exit liquidity. Lenders will charge an extra 150 basis points or 200 basis points to make that loan, saying, look, I'm going to be stuck in this instrument where I have no exit. So I'm going to charge you a premium to make that loan to you. Now, if we do enter a world in which there is secondary market liquidity in the space, that premium will collapse. So borrowing will get cheaper for people in the market, and there'll be a convergence in private and public credit. There's still some differences between those two worlds. It's not just simply, well, one trades, one doesn't. There's other elements to it, but particularly the investor base. But that illiquidity premium should come down. And then it also, to your point you mentioned, it increases the transparency in the asset class, because right now you have a situation where that same private credit loan can be held by like 3 people, right? These loans are typically held by like 3 to 5 people. It's very thin liquidity, and everyone marks it once a quarter using a third-party firm, but that mark can be different across different lenders. So the same loan can be held, 3 or 4 points differently in a different person's book. If you have a liquid solution where there's an observable price at which transactions have occurred, all of a sudden that dispersion is collapsed. So the illiquidity premium collapses, but also the dispersion in marks collapses. So I think it solves, multiple problems. But there is pushback against this, so it's not something that's going to happen overnight. I do think there will be a movement towards it over time, because it's such an obvious solution. But you need to get all the constituencies on board, because some people earn money by keeping things illiquid.
Oh, of course.
But I think it's a matter of time before that convergence happens.
Yeah, I mean, we're not disrupting the financial industry wasn't going to be a 5-year process with no fight. I'll tell you that. It's more like a multi-decade process. It's kind of this weird, like, it's coming, but you push back in the sense because, your margins are getting squeezed. But it must be interesting to be like on, in your shoes, speaking about this publicly, when, the counterparty to your loans or the firms you guys will work with, and, you don't want to be the, don't shoot the messenger, right? And it's kind of like the message is already out there, guys. So the leaders are clearly getting ahead of it and realizing how to build a better product stack for their, investors utilizing the technology, and then figuring out ways to then monetize in this kind of future product stack rather than trying to resist the inevitable is kind of what it seems like.
Yeah, you can't really hold back the tide. And even the big firms who were initially resistant, I mentioned them, they're at the forefront. Like, when you thought
Yeah.
about JP Morgan, everybody used to talk about the comments that Jamie Dimon made about Bitcoin, but they've been
Oh
at
yeah.
the forefront of being innovators in the space now. They are some of the most sophisticated, players in the space, and they're the ones we did the Galaxy transaction with. So I think people get it. It's inevitable, and even the big firms, they're becoming very innovative about this. You can resist it, or you can be the first mover in the space and take advantage of taking market share. So I think a lot of
Yeah.
the firms who realize this is coming are saying, look, let's not fight it. If you can't beat them, join them. And they're making all kinds of innovations in the space.
Yeah, I love it. Anand, thanks for your time, man. I know we're a bit past, but appreciate the conversation, and love the work that you guys are doing. And the whole world's coming on chain, one industry, one sector, one messenger at a time. So appreciate you, man.
Absolutely. Lovely being with you. So hopefully we can have many more discussions like this when the world decides to tokenize everything. So
That's right. Tokenize it all. Thanks, Anand.
right. Thank you.
Cheers, buddy. Alrighty, guys, the big boys are coming. I'll tell you what, they're coming, and they're gonna buy your bags too. After they bring all their infrastructure on chain, they're gonna purchase your favorite tokens. If you're in the right ones, if you're in the store of value assets and the revenue producing on chain businesses, they're not gonna buy your memes, Freedom Guy. They're not gonna buy your memes. Sorry to break it to you, buddy. Guys, what a show! 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 It's okay, Miss Gunn. Nobody's perfect. I came from OG TradFi FinTech. It's okay. No one's perfect. Yo, that is funny, man. This guy's a clown. Guys, what a show. I don't have much else for you. Actually, I do. I think we have something from the SEC that came out. And I'm kind of confused why we're not ripping. But I guess we're just still in the bear market. No surprise there. All right, here we go. Pulling up. Breaking news. Hit that damn stinger. The breaking news is here. Will create a clear and fit for purpose framework for certain investment contracts involving crypto assets. Details include the March 2026 interpretation clarifying how federal securities laws apply to certain crypto assets. Bullish. The rules will address long-standing barriers to capital formation and innovation within domestic crypto asset markets. Bullish. The proposed rules include 2 exemptions from the registration requirements of the Securities Act of 1933, specifically tailored to certain investment contracts involving crypto assets. Get those old rules out of here. Bullish. The proposed rules also include a conditional safe harbor from the term investment contract in the definitions of security in the Securities Act of 1933 and Securities Exchange Act of 1934. Get those old rules the hell out of here. Framework for broader crypto adoption is finally rolling out. Ladies and gentlemen, what do the charts say? Higher. The charts are telling you guys to bid. They're telling you guys to bid. I mean, they're telling you that this market wants up. I mean, I don't know if there's any other way around it. That is what they're telling you. They're telling you this market wants higher. Look at this, Johnny. Look at this, Johnny. Nice little rally here. We got a ways to go. But boy, oh boy, we're going sideways, guys. We're going sideways. We're not going down anymore. We've been going sideways for, 2.5 months. Bro, we've been in a range for 2.5 months that has literally been like a 15% range for 2.5 months. Oh my God. You know what the problem is? 81 days. You know what the problem is? Is that this is giving 2017 vibes. or 2018 vibes. Let's go way back. You guys are not going to want to see this. This is giving 2018 vibes. Range bound, 105 days in like a 15% range. You want to start here, 77 days, 15% range, followed by a 49% nuke. That'll tingle the cojones. So that's like the only comparison that you don't really want to see, but you can't unsee these things. And so just something to note. It's interesting. We're at 84 days in the 15% range. You know, could go a little longer. And then maybe you see that final move, but maybe you don't. I don't think it'll be 50%. That's for sure. More Clarity Act without even the Clarity Act. Exactly, man. Exactly. New rules bullish. LFG SEC delivers L to Pocahontas. Yes. Bro, I just opened the short. Now, I don't know if you should do that, man. I do not advise shorting anything down here. As you guys know, we are accumulating bags of what we believe in long-term right here in these levels. And we want to see these things rip much higher. So don't have much for you guys on the markets as we kind of close out here. Great show. Let's get some W's in the chat. Let's get some vibes up. What are you guys longing? What are you guys shorting? What are you guys doing into tomorrow? Beautiful day in New York City. Lovely day. Thank you for the show. Thank you for guys for being a part of the show. Thank you for being here. Thanks for supporting our channel. A like, a subscribe, notifications on goes a long way. Smash that like button right now if you haven't today. W's in the chat. What a show. Rain or shine. The crypto adoption cycle is rapidly increasing, regulatory-wise, institutional-adoption-wise, retail investment-wise, on-chain trading-wise. The infrastructure is maturing. There is an importance of having these physical spaces for collaboration. That's why we're here in the Nest, in the Empire State Building, in the capital of the world, the financial capital of the world, the most iconic building in the city of New York. W's in the chat. NOCSM, great to see you, man. Great to see you, Freedom Guy, Little Miss Gun, Mumu Evans. Can't wait to see you guys tomorrow. Chat more. Let us know in the comments any other thoughts, questions, takes. That token buybacks video is on our channel live now. You'll see it there. And we got more bangers coming. We got Mert and we got a Zcash dev tomorrow. We got a banger show tomorrow. We got a great show to end the week. I'm feeling good. Market's feeling good. Bitcoin looks like it wants higher. Bitcoin is demanding higher. Bitcoin is not stopping until we go higher. I think it's all but written in the stars at this point. Let's get above 65. Let's get above 67. And let's pop this thing up to 80s. What do you guys say, huh? What do you guys say, huh? You know where to find us tomorrow. Same place, same time. Live from the financial capital of the world. W's in the chat. Let's give our team a round of applause on the production side. Crushing it as always. We'll see you guys tomorrow.